Hello everybody, welcome to this Fair Tax Week webinar, where we're going to be talking about a new standard the Fair Tax Foundation have launched with which to assess businesses and award them the Fair Tax mark. I'll just give a couple of seconds for more people to join and then we'll get started. Hope you've all been enjoying Fair Tax Week so far, wherever you are in the world. It's very hot where we are, but it's been a good week so far. So I think we'll just get started. So my name's Natasha Turner. I'm a freelance research and communications consultant, and I've been working with the Fair Tax Foundation for a couple of years now, and I'll be chairing the discussion today. So in a minute, there's going to be a question that flashes up on your screen. Please select an answer so we can get a sense of where everybody is on their responsible tax journey, and then our first speaker can hopefully address the right kind of information that you're going to need. So our first speaker today is Jamie Boswell. He's the head of accreditation at the Fair Tax Foundation. Jamie comes from an accounting and tax background with professional qualifications and experience in both. He previously worked for a range of accountancy firms, from small family businesses to one of the top 10 accountancy firms, and has experience working with a variety of clients, from small sole traders to big PLC corporates. So Jamie's going to be talking about this new standard itself, also introducing the Fair Tax Foundation a bit for those that don't know about it. And then there's going to be time at the end for some questions. We're then going to hear from the first business accredited with the Fair Tax mark using this new standard, Tripseed. And we're delighted that Tripseed's co-founder and Chief Growth Officer, Ewan Clucky, joins us today. Ewan is a postgraduate from Manchester Business School, a chartered marketer, and member of the Academy of Marketing. Being an avid traveller, Ewan parachuted into the travel industry some 8 years ago and hasn't looked back. Living in Thailand for the best part of a decade, he has worked on some of the biggest brands in destination management, overseeing teams of experts around the world from New Zealand to Mexico. He's operated across Thailand, Vietnam, Japan, Indonesia, and more before launching Tripseed. And we're delighted that accreditation has launched today. And then last, but definitely not least, we're going to welcome Francois Marlier, a senior manager in the ESG tax practice and the Nordic lead for ESG services in tax and legal at KPMG Acor Tax in Denmark. Francois helped multinationals in the Nordic countries navigate the tax and legal aspects of sustainability and ESG transformations, and has particular expertise on responsible tax, transparency, and sustainability reporting. Before joining KPMG in 2020, he worked as a risk manager at Euroclear in London, a global financial market infrastructure, and then as a risk consultant in the renewable energy sector in Alice. Francois became a GRI certified sustainability professional in 2021, and he's going to give us a bit of the wider context to this discussion. So, with that great lineup there, I'd like, with no further ado, to hand over to Jamie.
Shall we have a look at the results of the poll? Okay. Pretty mixed bag of answers. Okay. Right, let me just share some slides. Bear with me. Hopefully everyone can see those slides. So for those on the call that don't know what the Fair Tax mark is, it's basically an independent certification for responsible tax conduct and transparent tax reporting. It was developed by the Fair Tax Foundation, which is us, a social enterprise that's rooted in civil society. All assessments and certifications are managed by qualified accounting and tax professionals with a vast experience. We're widely regarded as the gold standard of responsible tax conduct. So a little bit about our journey so far. So we've been certifying businesses since 2014, so about 12 years now. We originally started in the UK, and it was a UK certification scheme. But quickly, we had growing demand for the certification from businesses outside of the UK, most of which were mainly multinationals at the time. So in 2021, we launched the Global Multinational Business Standard. And this standard was around 2 years in the making, calling on feedback from a wide range of key stakeholders. And so to date, we have over 275 businesses certified all across the world. Collectively, they employ collectively over 475,000 people and contribute 4.8 billion euros in corporate income taxes alone every single year. So why did we create this new standard? So for the sharp-minded among you, you might have noticed that we could certify businesses in the UK. And then when we launched the Global Multinational Standard, we could certify multinationals that were all over the world. But basically, there was no standard for businesses outside of the UK that were operating in one country. And so again, through increasing demand from businesses, civil society, municipalities, and even investors for the fair tax mark to be available to a wider universe of companies, we created this standard. So now this new standard opens up the fair tax mark certification to a wider group of responsible businesses worldwide, whether you're a multinational or just operating in one country, all businesses now can be certified with the fair tax mark. So why does this matter? Why does the fair tax mark matter? Why does responsible tax conduct matter? There's loads of reasons why this matters, many of which have been covered this week in Fair Tax Week in our various sessions. But one matter that is a real hot topic at the minute, and that keeps coming up time and time again, is business risk. So we know that aggressive tax planning can cause heightened scrutiny from tax authorities, policymakers, investors, civil society. We know that aggressive tax conduct can cause reputational risk, which is really important these days. Obviously, a business's reputation is massive. We know that it can cause volatile earnings because obviously we don't want earnings to depend on how good a business is at avoiding its taxes and whether legislation changes are going to impact earnings. We also know aggressive tax planning can cause long-term value erosion. So then if we flip this on its head and we think, actually, so what does responsible tax planning cause? And what does a certification from an independent scheme like the Fair Tax Mark do to a business? Well, we'll flip all these on the head. So it's less scrutiny. It's positive reputation, a promotional reputation, less volatile earnings, and long-term value creation. And in my opinion, and probably a lot of others as well, a business's tax conduct is quite a good indicator of how it truly operates because basically tax mainly happens behind the scenes. And so that's how you can gauge how a business truly operates because it's not in the public domain, it's quite behind the scenes. And so if a business is aggressive with its taxes and it's trying to do everything it can to play the game and stuff like that, at the end of the day, it's probably a good indicator that it might be doing that in other areas too. But again, conversely, if a business is doing the right thing with its taxes, it's being responsible, it's being transparent, open and honest and wanting to do the right thing, then it's probably a good indicator that also in other areas, it's also doing those things as well. So if you want to know if a business is doing the right thing, maybe look at its taxes first. So what does the Fair Tax Mark stand for? So we have this slogan at the Fair Tax Foundation, which is paying the right amount of corporation tax in the right place and at the right time. So how does a business do that? It must start with intention and attitude, and this must be robustly governed throughout the business. So there should be no artificial or aggressive tax avoidance. All tax should be within the spirit as well as the letter of the law, no exploitation of unintended loopholes. And if there is a genuine uncertainty around tax, to be responsible, proactive, maybe gain external advice, but don't just gain external advice. Convey the message. We're unsure, we need advice. However, we are responsible. We don't want to push the limits of the law. We want to comply with the spirit. We don't want an uncertain tax position to materialize in the future. We need genuine help. It's about responsible tax conduct and this all being robustly governed throughout the business. And another final one is tax transparency. At the end of the day, if you're doing everything right, then you've got no reason not to be transparent. There's a saying, transparency is the best disinfectant. I truly believe that it is. If a business is up to shady things with its taxes, it's probably less likely to want to publish extra stuff and be transparent about what it's doing because it's exposed. And so if a business commits to being transparent with its taxes, and if a business commits to all these responsible tax policies and it's robustly governed through a strategy, then naturally this will lead to paying the right amount of tax to the right places and at the right time. So what does the new standard cover? It covers 4 main areas, which I'll go into a little bit more detail in the next slide. But these areas are basically number 1, general transparency, number 2, tax policy, governance and compliance, number 3, tax note disclosures or tax transparency, and number 4, tax contributions. So what does good performance look like on this standard? We're not talking about excellence. We're not talking about scoring full marks and doing everything and everything. We're talking about what does performing well in each of these areas look like to enable you to get over the threshold and basically be eligible for a certification. So number 1, financial transparency. We're looking for a full set of financial statements in the public domain, as well as details on beneficial ownership. Now, this might sound super simple and a small task, but in the UK, we have, you could call it a beneficial ownership register within limits because it's certain thresholds. So that's not too bad. However, small businesses in the UK do not have to disclose any details about turnover, profits made and taxes paid. So if you're dealing with a small business in the UK and you want to go on Companies House and see like, you know, is it a viable business? Did they pay the taxes? What are they doing? You wouldn't know. You won't know that information. You can't get access to it. Overseas, there's jurisdictions that do the opposite thing. So you might have to pay a little small fee to be able to access a full set of financial statements. You can see the turnover, you can see that they're profitable and not going to go bust and then not be able to finish the work off, that they're paying the taxes and they're doing the right thing. However, you've no idea who's behind the company. You don't know where the money's flowing to. You don't know who's ultimately benefiting from the company. And so in general transparency alone, we're looking for a full set of financial statements and details on beneficial ownership as a good performance in that area. Number 2 is a clear public tax policy, public, with responsible tax commitments, highly responsible tax commitments. Commitments like we've mentioned previously, following the spirit as well as the letter of the law, the way the law is intended to be followed, and responsible and proactive. Number 3 and number 4 are combined. So number 4, we look at tax contributions, right? If you're paying taxes, fantastic, great, that's amazing. But there are many reasons why a business would not be paying headline rates of taxes. For example, they might have made a few losses in previous years, and therefore they can carry forward those losses and offset it against current year profits. And therefore the tax rate for that year would be slightly lower. They might have invested heavily in plant and machinery and capital, and therefore allowed to claim accelerated tax depreciation, which is in the spirit of the law. Obviously, that's why it was designed that way, and that would impact tax rate. So they're all fine. The caveat is it must be explained though, and explained in a clear way, in a way that non-accountants and non-tax professionals would actually understand. Do you know what I mean? These accounts, you have a wide range of stakeholders for these accounts. It isn't just tax and accounting professionals. It can be consumers, it can be shareholders, other stakeholders. And the tax explanation should be a reconciliation between expected taxes and the actual taxes paid. And the reconciling items need to be clear. You can't have a reconciliation that says other or provision. That just doesn't tell us anything. You might as well not have a reconciliation if that's the case. So it needs to be clear reconciling items, and these reconciling items supported by narrative, just a bit of narrative, just to say like what's happened in the year, why it's happened, and how it's impacted the taxes or will impact the taxes going forward. Strong disclosure turns tax conduct into something stakeholders can see and really understand. So, what is the standard really assessing? So, it's not just about being compliant. Compliance is the floor, it is not the ceiling. It's about a visible and credible commitment to responsible tax behaviour. It's about a public, responsible tax policy that is robustly governed and implemented throughout the business in all its decisions, in all its operational decisions. And it's about being transparent with stakeholders about the taxes you've paid and explanations as to why it might not be on headline rate. The assessment looks for behaviour that is evidenced in public commitments, reporting and governance. And it's not just about headline tax rate paid. It's a massive misconception. We've had discussions in the past with businesses that are saying we're doing the responsible thing on taxes and we love what you do, but we're not going to apply just yet because we're not paying as much taxes. We're not paying the headline rate of tax, basically. So when we are, then we'll apply. That's not the case. At the end of the day, like I've already said, if you're not paying headline rate of tax and you're doing the responsible thing, operating with the spirit of the law, and you're willing to be transparent, there is no reason why you cannot reach out and become certified with us. So, coming my section to a close, I would like to introduce the first business certified on this new standard, Tripseed. They are the first in a lot of areas. They are the first business certified on this new standard, obviously. They're also the first Fair Tax Mark business certified in Thailand, and they are also the first certified in the travel sector. So Tripseed were assessed during the development stage of the new standard. Tripseed reached out multiple times in the past and said, I want to get certified, I want to get certified. And this standard was able to do that. So they was in the development stage with us. And Tripseed provides a strong example of exemplary tax reporting and responsible tax behaviour. For a company the size of Tripseed, they've done 2 annual tax reports now, and they truly are exemplary. So it is my pleasure to hand over to Ewan to talk about Tripseed's journey and why they got involved with the Fair Tax Mark.
Thank you, Jamie, for such a warm introduction. I'm Ewan, the co-founder and chief growth officer at Tripseed. We are a destination management company based in Chiang Mai in Thailand. In simple terms, that means we work in the sort of back end of the travel industry. We design and operate private tailor-made trips across Thailand for tour operators and travel advisors in the UK, the US, and Europe. We're essentially the people on the ground who turn someone's holiday into something real. 2 things make us a little bit unusual in the DMC sector. So first of which is we are a People and Planet First verified social enterprise. We're 70% Thai owned, majority women owned, and we have a legally binding commitment in our own governing documents to reinvest more than half of our profits into environmental regeneration and social justice work. This isn't something we just do for marketing. It's written into the very legal documents of how our company is structured. The second point, and the reason I'm here today, is because we became the first company in the world to be awarded the Fair Tax Mark under this new national standard for global businesses. So for a small DMC in northern Thailand, that's not really where you would expect a global first to come from, but it's something we're extremely proud of. But we also hope it doesn't stay unusual for so long. So the obvious question is, that's probably on everyone's mind, is why would a travel company care this much about tax? And that's what I want to talk through a little bit today. Tripseed was really founded on one core idea, and that's that tourism should leave more behind in the places it touches than what it takes out. We measure how much of every trip stays in the local economy. We choose our suppliers on that basis. The whole business is organized around local economic retention and the quality of the money that is retained. So how much is legitimately being retained by the local communities that we work with? How much benefits other women-owned and women-led businesses? How much genuinely supports other SMEs and locally owned suppliers? Over the last 3 years, we tried to measure exactly that. We began building our own economic transparency work, which it was tentatively named the Economic Distribution Disclosure Initiative, as a way to track how much of each trip's value genuinely stays in the destination. And then we ran into a wall during that process. So much of this industry runs on offshore revenue recognition and opaque ownership structures that you often can't tell on any public record how much an operator actually retains locally. The money may never even touch a Thai bank account. That was the moment tax moved towards the center of our thinking. Corporate income tax is one of the few parts of this picture that can be evidenced. It's filed, it can be scrutinized, it can be independently assessed. So it became our way in. If you want one honest, verifiable signal of whether a company is really contributing to the place it profits from, look at what it pays in tax. And that matters hugely in our sector and in Thailand specifically, because the structures designed to move profit out of the country and minimize what is paid locally are pretty well documented. It's a quiet problem that almost nobody in responsible tourism talks about. The turning point for us was looking honestly at the sustainability certifications that we either held or were considering. We had been a Travel Life partner. We had looked seriously at B Corp. And we realized that none of them asked the most basic question of all, which was, does this company actually comply with the law and pay its taxes where it operates? You could be a celebrated and certified tourism business here, yet still be using illegal ownership structures and still be routing all of your profits offshore. And that gap bothered us enough that we stepped away from those schemes and published an open letter explaining why. So when we found the fair tax mark, it was the one credential that addressed the very thing that we thought mattered most and that everyone else was being silent on. It wasn't a nice to have for us. It was really the missing piece in the message that we were trying to convey. I want to be quite honest about how we got here, because the timing is part of the story, as Jamie just mentioned briefly. When we first reached out to the Fair Tax Foundation, there was not actually any standard that we could apply for. They had their national standard for UK registered businesses and their multinational standard for businesses operating across several countries. We were neither. So rather than wait, we went ahead independently last year and published our inaugural tax disclosure referencing the GRI 207 standard. We put our numbers in public before there was any mark to earn for it because we believed in that transparency on its own terms. It was only when we got back in touch with the Fair Tax Foundation that we learned a new global national standard was in development, and we were extremely keen to be part of it. Adapting our existing GRI 207 disclosure from last year with the latest data and to meet the new Fair Tax Mark standard turned out to be a remarkably straightforward process because, Jamie and the Fair Tax Foundation team really guided us through it. They gave us a full points-based scorecard showing exactly where we could strengthen our data, what we needed to improve, any sort of elements we were missing that we could add in to really meet the standards that is expected of fair tax accredited businesses. And that clarity made a process that could have felt quite daunting, genuinely manageable. And it gave us something that I had not expected, which was confidence. Once you have been independently assessed against a clear standard and you can show your data and show your evidence, you stop worrying about whether your marketing claims will hold up because it's all there on paper. Let me be a bit practical about the benefits, because I don't think anyone should or needs to do this purely out of principle. I think it makes business sense as well. The first is trust. Our entire B2B model depends on partners in the UK and Europe believing what we tell them. Those partners are under growing pressure on their own supply chain integrity and ESG commitments. So a verified independent mark on tax conduct is something they can point to with confidence. It moves us from saying, just trust us, to here is the evidence checked by someone else. For partners, I think that matters a lot because responsible sourcing is becoming less about accepting good marketing stories and more about proving supply chain integrity. The second is differentiation. In a crowded market, anyone can claim to be responsible, and many do. Very few can show an externally verified position on tax. It sets us apart in exactly the conversations where it counts. And the third is internal. It's one more thing that lines up with who we actually are as a business. When our mission is to create local benefit and reinvest in the communities that our business impacts upon, then paying fair tax is not a constraint that we can tolerate. It's the mission. It's our mission expressed in the most concrete way there is. And that leads us to why I would encourage others, especially in tourism, to take this seriously. Our industry moves enormous sums of money around the world. Whether a destination genuinely benefits comes down to where that money lands and whether it is taxed fairly. We've spent years and years in responsible tourism talking about carbon emissions, single-use plastics, community projects. All of those things are important, but we've largely ignored the question of whether operators are even paying their fair share in the countries that they're profiting from. Tax transparency is the missing piece of responsible tourism. Destinations carry the real costs of tourism: roads, waste, access to water, public services, environmental protection, community pressure, and the everyday infrastructure that makes a visitor economy possible. You cannot credibly claim to support the communities of a place while quietly arranging not to contribute to the place itself. The fair tax mark gives us that conviction in a structure and an independent stamp. It turns value into something verifiable. And that's quite rare, and I think it's worth quite a great deal. So that is our story in short. A small company a long way from Manchester that came to the fair tax mark, not as a box to tick, but as the clearest expression of what we were already trying to build. If responsible business means leaving more behind than what you take, then how you handle tax is not a side issue. It's really the heart of it. So thank you, and I'll be very happy to take questions later on in this session.
Thank you very much, Ewan, and yeah, it'd be great to pick up on some of the elements of your experience there later. But now I'd just like to bring in Francois, who's going to talk about this standard in the wider context of the ESG environment right now, and in particular, the landscape for tax transparency, ever-changing legal obligations, and how companies might seek to differentiate themselves, as you've already mentioned, Ewan. So, thank you, Francois.
Thank you, Natasha. So let me start by saying that I believe this new standard to be a great new addition to the Fair Tax Foundation lineup of standards. I think not without reason, the initial focus of the responsible tax and transparency movement was on large multinationals. But as we just heard with Tripseed's fascinating journey and from Jamie's presentation before that, single jurisdiction businesses as well as smaller businesses deserve both attention of stakeholders and the opportunity to showcase their efforts and prove their own responsible tax credentials and how these contribute to their own sustainability strategy. So this new standard arrives at an interesting point in time. After what I think is close to a decade of strong growth in the number of transparent corporate taxpayers and in the quality of such transparency, it recently felt, to me at least, as if we'd reached a bit of a plateau. Many of those companies who either intrinsically wished to be transparent about their tax affairs or had faced demands from investors to do so, had by now achieved a level of maturity they were comfortable with. And in the tax world, these past couple of years, large businesses were dedicating a lot of their time to the global minimum tax. And I think we're waiting until new regulation and new obligations would kick in to turn again their focus to tax transparency. Next to that, sustainability teams, at least in Europe, were first grappling with the EU Green Deal and associated reporting obligations, and later dealing with the pushback against ESG that was gaining momentum and culminated in the EU's massive deregulatory drive. Now, however, what we're seeing is that the floor for tax transparency is being lifted again through regulatory means and putting hundreds and hundreds of companies with it. So there's public country-by-country reporting in the EU. There's public country-by-country reporting in Australia. And not to be forgotten, the disaggregation of income tax paid under US accounting rules. And while far from perfect, these new rules combined and for some companies quite literally combined, they offer stakeholders a wealth of new information. And I think for what feels like the first time in a while, we're seeing again stories on tax paid, tax avoidance, aggressive tax planning, which are being picked up in more mainstream news. So of course, these rules do not apply to single jurisdiction businesses. But as many countries continue to have existential debates on climate adaptation, decarbonization, and funding welfare states, topics which are only exacerbated by the specter of AI, I expect these new regulations and the fact that more companies have to comply with them will bring about more scrutiny and interest once again in tax, transparency, and good governance. And this will likely impact all companies. So this brings me to another reason why I find this standard both valuable and timely. Beyond the information that tax reporting provides on whether or not companies pay the right amount of tax in the right place at the right time, responsible tax management is essentially about good governance, accountability, and business conduct. I personally see bad tax management and aggressive tax planning and resistance to tax and financial transparency as indicators of a corporate culture that risks enabling business misconduct in general. In addition, over-reliance on low tax rates can indicate an inability to adapt to change in regulatory environments. So I think it's a useful tool for investors and other stakeholders for due diligence purposes. Related to that, I recently saw a report by GlobeScan, a consultancy that surveyed perception of ESG reputational risks amongst corporate affairs professionals. And so interestingly, they found that governance-related reputational risks had sharply grown and overtaken, in the corporate affairs professionals' minds at least, environmental-related reputational risks. And while the eye-catching part of the fair tax standards is the reporting on tax paid, it goes well beyond that. The standards expect transparency on beneficial ownership, financial accounts, tax policy, the approach to tax risk management. And this, I believe, is a key aspect of responsible tax and good tax reporting, explaining not only the expectations of the board around tax management, but how these expectations are met, how risks are identified and managed, what controls are put in place to manage those risks and reach the objectives of the tax policy. When we talk to investors about their expectations, we hear that corporate tax data and effective tax rate is often used as a flag, as a way to identify companies where they need to look into more detail, and they need to dive deeper then into the narrative, if there is one, information on tax governance, and the risk and control framework. And again, while the fair tax mark focuses more on corporate tax paid, as those are more easily comparable against statutory rates and even against other companies, the expectations they set on tax governance and risk management cover all types of taxes. And in my view, the quality and effectiveness of controls surrounding, for instance, VAT-related processes are a good measure of the maturity level and seriousness, let's say, of tax control frameworks. And while I think we've seen recently that the VAT gap has steadily decreased in the UK in recent years, it did less so in the EU, where the EU Commission announced last year a renewed focus to improve VAT compliance and combat VAT fraud. So to close, I'd like to note that we've recently started hearing from clients who received requests from prospective business partners and clients as part of procurement processes to share the tax footprint data. I think that tracks pretty well with what Ewan was saying himself. So while this is fairly new, I think it's a logical step, as ESG matters are increasingly becoming decision factors for large investments and new business relationships beyond just climate data. So the standard and the fair tax mark can thus be both the right thing to do, morally, ethically, but also the right thing to do from a more basic business perspective. An indicator, a differentiator, and a way to cut through the noise, and ultimately help lift the bar for everyone. So yeah.
Great, thank you. Thank you so much. So now we have a bit of a time for questions. I have a few questions myself, and I can see there's already a couple coming in. Please put your questions in the Q&A function, and we can address them to all of our wonderful panel here. But I just wanted to pick up first on your last point there, Francois, and actually I'm going to ask you a similar question, Jamie, as well. which is what barriers, Francois, do you see either real or perceived from businesses either wanting or maybe not wanting to be more transparent on tax?
Like, I didn't catch the first part of the question.
What are the barriers, either real or perceived, that businesses come with?
Yeah. I think what we've seen typically with companies that wish to be transparent, it started often with a single person, maybe the head of tax or someone who deeply cared about it themselves and had to bring the topic to the wider management team, to sometimes the board. Although sometimes we've seen the topic coming from a board member who has experience on that topic. But so it needs to be initiated from someone. And in some other cases, it came from large investors who have made it their business. But I think a big barrier is cultural. And I think Jamie was mentioning that the different expectations, regulatory expectations around transparency on financial accounts and stuff like that. I think this is very much the same around tax and transparency. In some countries, tax are considered such a private thing. It's unacceptable to have to share tax data. Whereas in Norway, every year they publish what individuals pay in personal income tax. I think there's a massive difference there, and so that can be one big barrier to overcome.
Yeah. Okay. Well, coming to you with a similar question then, Jamie, and maybe you want to pick up on that, because this new standard it will ask the same of businesses across different jurisdictions, right? So how do you overcome some of those cultural barriers? And what do you or the current 275 certified businesses say when it comes to some of that maybe nervousness about putting info public, or some of these barriers that Francois talked about? What would you say to that? And then also, I know there's plenty of businesses out there who also have something to say about that.
Yeah, I think it doesn't necessarily apply to this standard, but one of the biggest barriers we faced in the past was with multinationals publishing public country by country reporting data. But one big thing that we're on with at the minute is, we've been advocating and certifying businesses with public country by country since 2014. So we've got lots of experience going through country by country reporting, helping with the narrative. I think the narrative is the thing that's missing these days. The data can paint 1,000 words, and you don't want to let your stakeholders or journalists or outsiders tell you your narrative. You might as well tell them exactly what's happened. So one example was we was accrediting a company once that had profits in a jurisdiction where there was no staff. And so without any narrative, that just looks really suspect. And we were saying, well, what's the reason? What's going on there? And they were saying there is people there, but they're not staff, they're contractors. So, and I was like, if you just put that in your narrative, that just puts that issue to bed completely, about economic substance and things like that. So I think there's many barriers to businesses doing this, from they don't want to be sharing maybe the commercially sensitive data and things like that. But we aren't slaves to a fixed set of rules. There's many ways a business can become certified. You can do it through narrative. You can do it through, there's many different ways. You don't have to do everything. We can work with a business to make them tell their tax story, in effect, in a way that gets them over the line, gets them certified, but that is also transparent about what it needs to be transparent about.
Presumably, there are a host of businesses around the size of what this new standard will certify that maybe we're worried about publishing tax strategy or beneficial ownership data, have done it, been certified for years, and have seen it only as a benefit, right, rather than something to worry about.
Yeah, exactly that.
Yeah. So I'll pick up on a few things in the chat. Yes, the webinar will be online later, Rob. So don't worry about getting everything down now. There's a question that looks like it's for you, Ewan, about the process, which you did cover, but it was interesting when you're talking about GRI 207 and with the poll at the start, it looks like most people are kind of, well on their way with this journey. So yeah, maybe you can expand on that a little bit.
Yeah, I mean, let me caveat what I'm about to say with the fact that I think when we eventually were coming to get the fair tax mark, we were already starting from quite a strong base, having done the GRI 207 report, and the standards there, they're available publicly online, and they're very, very clear in how you need to be reporting the taxes that you're paying, any uncertain positions, everything that you need to be GRI 207 compliant. And it's written in a very, I'm not a tax expert myself. I'm a business owner in the travel industry, but it was written in a way that it was easy to understand even for myself. And so I think following that guidance, and then having received the further scorecard guidance from the Fair Tax Foundation, and when we were working through that process with Jamie, it was just written in such a way that it was easy to sort of, look at the points where we were sort of. I think from our first year's GRI 207 report, we were about 2 points short of achieving the fair tax mark or something around that. And it was clear from the Fair Tax Foundation scorecard what areas we were missing data in, what we could be more transparent about. And it was, yeah, I mean, all I could say was it was extremely transparent, and it's probably the least onerous sustainability reporting that we've actually done. If you compare it to calculating our climate impact, what our carbon footprint is, anything like that, this was so much easier than any of that.
And putting aside the years when there wasn't a standard available for you, once you started that process, how long did that all take roughly?
In terms of time applied to full-time working on the standard, it probably took us about 3 days. I'll admit I used some AI to assist us to help. I plugged in our annual financial report, which we submit to the government. All that data is readily available. Most businesses have to provide that data to their governments, as a requirement anyway. So I plugged that in and plugged in the GRI 207 standards and said, give me a report from our data that meets the GRI 207 standards. And that did the lion's share of the work. So it only took about 3 days to put that full disclosure together. And then maybe another 2 or 3 days to actually do the fair tax mark, to elevate that to the fair tax mark standards, once we had our following year's annual reports ready as well.
Yeah. Jamie, does that tally with your experience with businesses more broadly?
Yeah, so I was going to say, I mean, obviously Ewan's a unique example because he came prepared, so to speak. But in a usual assessment or certification cycle, we know how busy everybody is, whether you're a small owner-managed business or whether you're a large multinational. At the end of the day, time is precious. And, I've been there, we've been there in previous roles. We don't want this to be a pressure, a burden, something to dread. We want this to be something that is genuinely insightful and worth celebrating. So we basically do a lot of the work. So Ewan said he spent 2-3 days on it. We spent, say, 4 weeks on it. Right. So we do a lot of the work behind the scenes. Yeah. Everything that's in the public domain, we will go in, we will assess, we will scrutinize, we will ask questions, we will generate a report, we will tell them where they can improve, where they're already excelling at, fixing any mistakes that we find. We're not looking for mistakes, but if we find any, and we've got plenty of examples of where the mistakes have been made, we can fix them. And then we hand that report over and say, you've either met the standard or you haven't met the standard. However, this is how you can meet the standard. And so from a business's point of view, they reach out and say, can I be certified? We then look into that business, we send them a report, and then they've just got to action it. And then it's up to them. And in them actions, we can help them. So we can point them to other businesses that have said similar things, that have got tax strategies. We can point to how they can disclose it. We can help them with narrative, with explanations. Like for small businesses, like you said, maybe not tax experts, so they wouldn't know how to do a tax reconciliation. So send us the stuff, we'll do it for you. At the end of the day, we'll do the work. We just want to celebrate the businesses that are willing to be transparent and that are responsible and want this kind of thing.
Yeah, I heard it here first. Jamie is asking for work, more work, send it his way during this heat wave. Absolutely. Maybe this is a good time to pick up on Rob's question, actually, Jamie, about potential language barrier issues. You mentioned the multinational standard before, and in your presentation, there are companies across 8 countries currently certified. So maybe you want to make reference to some of those businesses and how that's worked so far.
We're talking about languages, my favorite topic. So one of my hobbies is learning or dipping into learning bits of different languages. I'm fascinated by languages and culture, but basically, it's sad to say, but English is the business language of most of the world. And to be fair, most big PLC documents, annual reports, and things usually do have an English version. But if they don't, we do translate it. And we can work around all those things. So language barriers isn't a problem. Francois was mentioning before, obviously, different jurisdictions have different attitudes, different laws, different regulations. We know that, but we think that the standards that we're applying can be applied fairly across the board. Yeah. And we know what certain countries and certain sizes and sectors are subject to, and we can work with the business around those restrictions on how to meet those standards in the best way possible. Yeah.
Francois, I can see that you're typing an answer to Rob's question here. Do you mind if I ask you to verbalize it as well? So the question is, when you spoke about the rising floor for tax transparency, you mentioned disaggregation of income tax paid in the US, he thinks. Could you say a bit more about that?
Yeah. So the Financial Accounting Standards Board, FASB, in the US, they finally passed, after years of trying, last year or 2 years ago, a new accounting standards, or an update to their accounting standard that requires companies to, amongst other things, report the amount of income tax paid per jurisdiction when it represents more than 5% of their total tax paid around the world. And so if you look around, and I remember that Paul Monaghan has wrote a couple of interesting pieces on LinkedIn when it started coming out, but you'll find that large US businesses have started putting that, reporting that data as it's now required. So if you go look for the accounts of Amazon, Tesla, Meta, etc., you'll find that data out there. Yeah, I think what's interesting with how it combines with their potential obligations in the EU and Australia is that you end up having information on a lot of different jurisdictions when you combine the disaggregation obligations of these different regulations. So yeah.
Question for you, and then, is there much public discussion or public awareness of corporation tax avoidance in Thailand?
I wouldn't say directly, but one related issue that we deal with a lot here in Thailand at the moment is beneficial ownership, because by nature of Thailand's legislation, tour operators and travel businesses in Thailand must be 51% Thai owned in order to hold a tourism operating license. And so any foreign owned businesses, or any businesses that are majority foreign owned, that they can't strictly, by the law, get a tourism operating license. That hasn't stopped people in the past. And there are a lot of businesses now operating in the tourism sector using nominee shareholders or proxy shareholders, which is actually illegal in Thailand, but it allows them to hold their operating license. And so, but by the nature of how this works at the moment, there's a big crackdown. There's about 46,000 companies that have been sort of listed by the government for investigation on this issue. And by the very nature of it, using a nominee shareholder, these companies that are using nominees don't want to be paying corporate income tax, or aren't paying corporate income tax as an outcome of not wanting to record profits in the country. If they record profits in Thailand, they need to be able to show that they're paying a share of those profits to these owners who are not legitimate owners in the business. So, to answer your question, no, people aren't talking about the corporate tax issue so much as they're talking about this beneficial ownership problem, which by extension it means that nobody's paying corporate income tax in the tourism industry.
It's interesting. Jamie, there's a couple of questions came in early on, and I think it might have been before you kind of got to it in your presentation. So you may have already answered this. They're about the rates that businesses have to pay if they want to be Fair Tax Mark accredited. And I know you covered it, but perhaps you want to just cover it again.
Yeah, I just wanted to piggyback onto Ewan's point as well, because we get asked the question all the time, what's beneficial ownership got to do with tax? And you've just explained it perfect. So thanks, Ewan. In terms of taxes paid, I mean, at the end of the day, it all depends on which jurisdiction they're operating in, what industry they're in. I mean, if you think about, energy companies, for example, that are like railway, companies, they're investing heavily in plant and machinery and capital. And so naturally, their tax rate is going to be lower than headline rate. And so that's completely fine. And at the end of the day, like I said in the presentation, the caveat is that's fine as it's all done within the letter and the spirit of the law. Just explain it. As long as you explain it in a way to stakeholders, external stakeholders that are non-tax or non-accounting professionals, what has happened and why, then it's fine. You don't need to be paying massive taxes.
Francois, did you want to comment on that?
Yeah, and because this reminds me of discussions we've had with some clients that were starting to fear using tax credits and tax breaks. They're fearful of the sort of narrative that would come out of that. And ultimately, the point was that there's two things. First, what is your policy around the use of tax breaks and tax credits and tax holidays and whatever? And do you have, again, processes in place to ensure that you just apply for those that meet your policy? But also, there are very good reasons for some of these tax breaks, tax credits. When we look at the green transition, decarbonization, there is so much that's put in place to encourage companies to invest in specific areas. And so you should, and many companies should end up being able to use some of these credits and breaks and thus have a lower than headline tax rate. And that's normal. And you can explain it and tie it with your broader sustainability strategy and story. So it's actually a positive ultimately.
Yeah, Jamie, do you want to mention the Fair Tax Foundation's position on tax credits, that kind of thing?
Yeah, 100%. At the end of the day, the Fair Tax Mark is an independent assessment done by tax and accounting professionals that understand, a business's taxes, and, governments put tax policies in place to be used. And as long as they're used within the spirit, then that's absolutely fine. Do you know what I mean? And then if there is uncertainty, then it's just about being responsible around that uncertainty, like I said. So, it is a massive, massive misconception that you must be paying headline rate of tax in order to be like a good business. It's just not the case at all. But people that aren't well versed in tax and accounting will look at a business and say, oh, that seems a bit low. And therefore, we would advocate for obviously getting certified, but if not, explaining why it's low so that stakeholders can understand, oh, this is a genuine relief and it's been done within the spirit and it's all fine, and it can explain why they're not paying headline rate of tax and it's for a good reason. That narrative matters. That narrative matters. So I would say to any business, in my opinion, like I said earlier, tax is cuts through all the rubbish really, and it's like a really good indicator of how a business conducts itself. And don't just let the numbers appear with no narrative around them. Explain your position so that there is no second guessing and there's no scrutiny. Yeah.
Yeah. And I think as you've all said, investors are looking, customers are looking, staff are looking. So yeah, make sure you've got that narrative right. We're coming towards the end, so I'm just going to ask you all for just a few kind of summarizing words, and then I will close up and let everyone get on with their day. So can I come to you first, Ewan? Put you on the spot here.
Sure. No, I mean, we're just really excited to be a part of everything that the foundation, the Fair Tax Foundation, are working towards, and to hopefully bring some more awareness of responsible tax conduct to the travel industry. We've got a series of blogs going out this week for Fair Tax Week about how fair tax can be, or is being I suppose, or how tax conduct is being abused and can be done better, looked at better in the travel industry, and especially around sustainability certifications and who is being called sustainable and not. And so I'm excited to be sort of leading that front on raising awareness and hoping that more people will join us towards being responsible taxpayers and paying their fair share in the right place at the right time.
Yeah. Thank you. Francois, any final words?
Yeah, I think it's something that we see is also that tax functions and communication teams and sustainability teams tend to keep each other at arm's length. Tax is very technical. Sustainability has been heavily focused on environmental issues, but they need to talk to each other. And if there's one thing I would encourage is tax teams to talk to their sustainability teams and communication teams and understand how all of that fits together.
Yeah, absolutely. And for anyone interested, on the Fair Tax Foundation's website, there are some great examples of Fair Tax mark accredited firms that include their tax reporting in their sustainability report. So you can see how other firms have done that if that is of interest. But yeah, still need to get the teams talking in order to do that. Any final words, Jamie?
No, I just want to say I'm excited that this new standard's been developed and now launched. And so I'm really looking forward to meeting and discussing with more businesses worldwide on how they can tell their tax story and become certified with us.
Great, lovely. So I think the link to the new standard has actually just gone out in the chat. If you're interested in that, it will be going up all over the website later as well. There's now another poll up just to see if you want to stay in touch about this. Please do get in touch if you're interested. So it's just for me to say thank you very much to our panelists today, to Ewan, Francois and Jamie, and have a great rest of your Fair Tax Week. Thank you very much, everyone.
Thank you.
Thank you.
Thank
Bye.
you.